Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about CRESCENT Energy Co. quarterly report. CRESCENT Energy Company provides a range of energy-related services, including exploration production of crude oil production of natural gas liquids. These activities are primarily focused on the United States, with a specific emphasis on Texas and the Rocky Mountain region. The significant drop in CRESCENT Energy Co. stock price. A multifaceted analysis. CRESCENT Energy Co.'s stock price has plummeted by over 30.93% in the past year, a decline attributed to a combination of company-specific news and broader market concerns. Several key factors have contributed to this downturn. Firstly, the company's underperformance compared to its peers is evident, with shares down 43% year-to-date as of April 2025. Analysts' EPS estimates for CRESCENT Energy sharply decreased over a 60-day period leading up to April 21, 2025, projecting a decline in profitability by 2.8% in 2025 and an additional 4.5% in 2026. The company's third-quarter earnings report on November 3, 2025, further exacerbated the situation, with a net loss of $10 million and a revenue shortfall compared to analyst estimates. The acquisition of Vital Energy for $3.1 billion also raised concerns about pricing details and exposure in the Permian Basin. Furthermore, CRESCENT Energy's reliance on acquisition-driven growth has clouded earnings visibility, while its Altman Z-score of 0.72 in August 2025 placed the company in a distress zone, indicating potential financial challenges. The decline in revenue growth and stock volatility have also contributed to the significant drop in the company's stock price. Overall, the combination of these factors has led to CRESCENT Energy Co.'s stock price decline, making it essential for investors to carefully assess the company's performance and prospects before making any investment decisions. The primary drivers of revenue growth or decline can be summarized into three main categories: natural gas and oil production, commodity prices, and operational changes. Revenue growth is primarily driven by the increase in natural gas revenue, moderate growth in oil revenue, higher sales volume and acquisitions in oil production, and higher natural gas prices. Additionally, midstream and other revenue have increased due to higher sulfur revenues and oil blending revenues. On the other hand, revenue decline is mainly attributed to lower realized oil and NGL prices, impairment expense related to oil and natural gas properties, and commodity price volatility. Net income and profit margins shift dramatically. The financial performance of a company underwent significant changes between two periods. Initially, for the 3 months ended September 30, 2025, net income decreased from -$5.6 million to -$10.3 million, while profit margins dropped from -0.9% to -1.2%. However, in contrast, the 9-month period saw a substantial increase in net income, rising by 388% from $32.3 million to $158.1 million. Concurrently, profit margins also improved, increasing from 1.6% to 5.8%. These contrasting trends suggest that the company's financial performance was marked by both decline and growth during these periods. The company is indeed generating positive operating cash flow. The financial summary reveals a significant increase in net cash provided by operating activities from $838,652 in 2024 to $1,309,140 in 2025. This substantial growth indicates that the company's operations are producing more than enough cash to cover its expenses and investments, resulting in a positive operating cash flow. The company's debt level and interest expenses have undergone significant changes. The total debt level has increased by $172 million, 5.6% increase, from December 31, 2024 to September 30, 2025, primarily due to the Ridgemer acquisition. Additionally, the long-term debt has also seen an increase. The interest expenses have witnessed a substantial rise, increasing by 17%, $10.8 million, from $61.8 million in 2024 to $72.6 million in 2025. This significant increase in interest expenses indicates that the company is paying more for its borrowed funds. Management is optimistic about the company's outlook, expecting increases in oil, natural gas, and NGL production. They plan to pursue potential acquisition opportunities to integrate operations and realize synergies. The company aims to reach certain thresholds by 2026 and 2027, while also divesting non-core assets for a total consideration of over $800 million. To achieve these goals, management will prioritize generating free cash flow and attractive risk-adjusted returns through acquisitions and operations. They will continue using economic hedging arrangements to protect cash flow and maintain liquidity. The company aims to fund its 2025 capital program through cash flow from operations, excluding acquisitions. Overall, the company's strategy focuses on growth through production increases, strategic acquisitions, and divestitures of non-core assets. Management is committed to maintaining compliance with debt covenants and meeting contractual commitments while generating attractive returns for shareholders. Acquisitions and divestitures overview. The company has made significant investments in acquisitions and divestitures to shape its business strategy. Key acquisitions include the Ridgemer acquisition, which involved multiple references throughout the document, indicating a substantial investment. Additionally, the Vital Energy merger was another notable acquisition. On the other hand, the company has also engaged in strategic divestitures to optimize its portfolio. In 2024, non-core assets were sold for $29.7 million in net cash proceeds and resulted in a gain of $19.4 million. Furthermore, the company redeemed $500 million worth of 2028 notes through a tender offer and redemption process. These transactions demonstrate the company's efforts to refine its business operations and allocate resources effectively. The company's financial summary reveals that it has engaged in two key shareholder return initiatives. Firstly, the company has paid dividends to its shareholders, as detailed on pages 35 and 59 of the report. Secondly, it has also bought back shares from the market, with further information available on page 38. Concerns about inventory buildup and supply chain disruption exist. Our company faces potential issues with inventory buildup and supply chain disruptions. Shortages of equipment, supplies, services, and qualified personnel are a recurring concern, pages 3 and 36. The ongoing hostilities in the Middle East and international trade rules may cause delays and disruptions to our supply chain. Additionally, OPEC's decision to increase oil output cuts by 411,000 barrels per day could lead to further volatility in commodity prices. Tariffs and trade measures may also increase costs within our supply chain, page 63. These factors pose significant risks to our operations and financial stability. That concludes the financial summary for Crescent Energy Co. Feel free to comment below, and I will be happy to answer them when possible.